Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the balance sheet and then the statement of cash flow. We went through a balance sheet, we built it from scratch, we talked about why it's important, what its limitations are, and then we talked about the flow of information through the different financial statements so that we can build a statement of cash flow as kind of our last financial statement. We talked then about what the purposes are of a statement of cash flow, and we started to build one. And that's where we're going to pick up now with this segment, is on finishing that statement of cash flow. So if you remember, we actually got through the first part of our worksheet calculations. We put in all the accrual information, that's what we know. We've got the worksheet built, so now we're ready to move on to the next step, which is calculating the changes in cash. Now, when we were doing this before, in our discussion of the accounting cycle, we talked about the cash to accrual conversion, and we kept it really simple. We only looked at those examples that were going to be operating activities, short-term assets, short-term liabilities. Now we're going to look at everything, because we want a full-blown statement of cash flows. And the first thing we want to look at is the difference between current cash, year 2, minus year 1, because this is our goal. We need to show a change in cash of $30,000, or we know we've done it wrong. Now let's look at the other balance sheet accounts and see how it changes. Now remember, when we did our pitcher thing, we poured water back and forth, and we looked at the flow of cash, and we said that assets and cash are kind of a teeter-totter. Whereas the assets go up, cash goes down, and vice versa. As the asset goes down, cash goes up. Liabilities and equity, remember, are more of the wave, whereas the liability goes up, cash goes up. As the liability goes down, cash goes down, same with equity. So, with that said, let's take a look at our accounts receivable. And we really here want to look at accounts receivable net. Again, this is my total amount of accounts receivable, but the two of these together, that's what I think I'm actually going to get. This is what I think now I'm going to get in accounts receivable minus that $10,000. That's what I think I'm really going to get. So I want one adjustment for both of these. And the way that I'm going to do that is with kind of a long equation. We're going to take the sum of these two numbers. Whoops, so we get the parenthesis the right way. Minus the sum of those two numbers. So basically what I'm doing is I'm taking the net accounts receivable, what I think I'm really going to get from year 1, minus what I think I'm really going to get from year 2. And that's going to give me $50,000 increase in accounts receivable. Accounts receivable went up. I didn't collect that cash, so cash must be less. Now, normally at this point, we would go through and do all of the different changes for all of my assets and liabilities, and I'd have all those change numbers. But normally, I have more space than I've got right now. So what I'm going to do to try to offset the fact that we don't have a lot of space here, first I'm going to shrink this, column F, so we can see this a little bit better. And the other thing I'm going to do is I'm going to put the changes into the worksheet as we go. Hopefully that will allow you to take better notes and keep track of where everything goes. If I were doing this for the first time and I had the space on my screen, which you probably do at home, if you right-click right here on column J and go to Insert, you'll get a second column. And now you can put in the description and then the amount. Again, I don't have space for that to be able to show you everything I want to, but that's how I would do it if I were at home going through this for the first time. Changing accounts receivable, it's a short-term or current asset, which means it does go into my operating section. It also makes sense because it's part of selling stuff to people. So it definitely goes in my operations worksheet, and it matches up with net sales. So I'm going to put this negative $50,000 right here in I-7. And again, you may want to make a note to yourself, that's the change in accounts receivable, net. All right, let's take a look at the next one. The next is inventory. And I'm going to take the $280,000 minus the $240. This is my shortcut, by the way. If I do it this way, if I take old minus new in assets, it does the sign for me automatically, right? You can look at that and say, wait, 280 minus 40 to 240, $40,000 change. Inventory goes down, so cash has to go up, right? It's the teeter-totter. That's one way to do it. The other way is just to set up the equation like this, old minus new in the asset section, and there's my positive 40,000, which is what we thought it would be. So now inventory matches up again as a current asset with something in the worksheet. What does it match up with? Cost of goods sold. Let's see, prepaid insurance. Again, I'm going to use my shortcut. I'm going to take old minus new, $15,000 change. I used up prepaid insurance instead of buying more stuff, so I have more cash in the bank. Prepaid insurance is going to match up with insurance expense. Next is my prepaid rent, negative 5,000. Again, 20,000 to 25. The asset goes up, so cash has to go down, teeter-totter. So I get that negative 5. Prepaid rent would match up with rent expense. So there's that number right there. Let's take a look over here. Now, these are long-term assets. Long-term assets don't match up with day-to-day operations, so they don't go in my worksheet. But we do need the changes in cash so that we can do our cash flow from investing and cash flow from financing sections later. So let's see. 60 minus 60 is 0, so nothing changed there. I'm going to copy this and paste it down. Nothing changes there. Land, there's a change. I went from 140 to 220. Land goes up, so cash must have gone down as I bought it. There's my building. Nothing changed with my building. I did buy a bunch of equipment, and I'm going to widen that column. There we go. Now, accumulated depreciation also changed, and if I were doing cash to accruals, I would use that to guess at what depreciation expense was. But in this case, I don't need to do that because I'm doing accrual to cash. And all I need to know when I'm doing accrual to cash is that depreciation expense is not cash. So I need to get it out of there. So with this as my reminder, I'm going to go to depreciation expense here in I-20, and I'm going to make this equal to a negative of that 40,000, so that when I add the negative 40 plus the positive 40, I get a 0 as my cash flow. And that's what I want with any non-cash items. I just want to cancel them out of there completely. And remember, it's depreciation, amortization, gains, and losses that I'm just going to see those numbers in my accruals and say, that's not cash, cancel them out, and I get rid of them. Let's see, patent stays the same. So I'll go ahead and put the equation in, but I don't really need to because I can see it stayed the same. Now we're going to scroll down and take a look at liabilities. Now liabilities, remember, it flip-flops. Instead of the teeter-totter, now I have the wave. And since I have the wave, I have to change my equation. So let's think about this. Accounts payable went from $120,000 to $76,444. If accounts payable went down, the best explanation for that is that I paid off a bunch of the accounts I had with my vendors. Well, if I paid them off, I have less cash. So now the equation, got to show up as a negative, is going to be new minus old. Since we flip from the teeter-totter to the wave, we flip-flop our equation. Now, for our class, we said that accounts payable was going to be solely for the purchase of inventory. And we broke out all of our other payables. So you can see a wages payable here and income taxes payable here. We're breaking out the other payables. So for now, this is just for the purchase of inventory, which means it matches up with my cost of goods sold. And there's my value right up here. Right, let's see. Income tax payable, again, we take new minus old. Goes from 20,000 to 35,000. I owe more to the government. If I owe them more, it's because I haven't paid them, so I have more cash in the bank. And that's going to match up with my income tax expense line. Unearned revenue goes up. Translation, we have received more orders for work that we have not done yet. They paid us, we haven't done it. But since they paid us, we have the cash in the bank. So this one is money we receive from our customers, so it's going to match up with sales. So there's our two changes for sales. Wages payable goes down, so I must have paid some wages. And over here we have two options for this. We can put it in executive salaries, Or we could put it in sales commissions. Those are both kind of wages that we pay. I'm going to put it into executive salaries. Now, you'll notice the stuff that's going into this worksheet, they're all current assets and current liabilities, because that's my day-to-day stuff. The one I'm going to leave out is this current portion of my loan payable. Loan payable, that's not operating, that's financing. So even though that goes into current liabilities, it's not an operating activity, so I'll leave it out. Let's go ahead and come down here to our loan payable. Long term, we went from 60 to 50, so I must have paid off 10,000. Here I go from 160 to 280. I took out more debt, so I got $120,000 in cash. Common stock hasn't changed at all, and retained earnings is kind of a special case. The only thing that's cash and retained earnings is the net income stuff that I've already captured up in my operating section. That's part of my worksheet. And dividends that I've paid. And that number we will need to get before we can move on. If we go to our statement of retained earnings, there's my dividend that I've paid. One quick little aside here with dividends. Dividends aren't always paid in the period that they are declared. The examples we've used so far, that's been the case, but it doesn't have to be the case. Companies can pay them later. Legally, however, as soon as you declare a dividend, you have to pay it, which means that as soon as you declare that dividend, it has to come out of equity through a debit to dividends and go into a dividends payable account, because you are going to pay that now legally. So we're going to switch it, right? If we think about our accounting equation, when I declare a dividend, equity drops, liability goes up, I pay off that liability, assets drop. That's how that kind of flows through my system. When I want to know if I have paid the same amount of dividends as I declared, what I look for if it is a dividends payable account. If I don't see dividends payable, then I must have paid all the dividends I declared. If I do see dividends payable, then I have to back in to what I paid. So I start with my beginning dividends payable. I've got an ending dividends payable. I figure out what I declared in dividends by looking at my statement of retained earnings, and the difference, whatever's left over, that's what I took out of dividends payable, that's what I paid. And that's how I would get to this number. Now in this case, there's no dividends payable, so this $50,000 in dividends must have been declared and paid. All right, let's go back to our statement of cash flows now. It's time to finish our worksheet. In order to do this, remember we take the accruals plus the change in cash to give us our cash flow. So I need to add these numbers to these numbers. So let's go ahead and do that. And again, anytime I have multiple adjustments for one line item, I always add them together first. I'm going to put in a line here and add those up. So my net change to net sales is going to be $30,000. So if I take the $1,770,500 plus that negative $30,000, this gives me my cash received from customers, or something similar. Let's see, rent revenue, $6,250 plus 0 means this is my cash received from rent. Cost of goods sold, oops, it's got two adjustments. So I will net that out and then add it. So I'm going to take the $1,094,717 plus the $3,556, and this is my cash paid for inventory. Okay, now I have several that don't change. Let me do that again. I went kind of fast. I'm going to take this 37.5 plus that number, because that's my equation, accruals plus the change. I don't have any other doubles that I need to worry about, double effects. So I can really just copy this equation all the way down, and I'm going to. So down it comes. All right, this is cash paid for advertising, cash paid for miscellaneous selling expenses, cash paid for sales commissions, cash paid for shipping. No depreciation, it went to 0, which is just what I wanted. That's what I should see. Won't worry about that. Cash paid for salaries. You can make it executive salaries if you want to. Cash saved from prepaid insurance. Cash paid for miscellaneous administrative expenses. Cash paid for office supplies. Cash paid for rent. Cash paid for utilities. Cash paid for interest. And cash paid for taxes. And finally, down here, this net amount, this is cash flows from operating activities, or net cash flows from operating activities, or cash from operations, cash flow from operations. There's a lot of names for it, but it's something about this is the cash from operating. Now, when we do a statement of cash flow, we have two options under GAAP. One is what we call the direct method. That's this. Cash received from customers, cash paid for inventory, cash paid for rent, cash received from rent, etc. I just list the exact cash amounts straight down. That's the direct method. And that's FASB's preference, is that we use the direct method because it tells investors exactly what we spent our money on. But there is one other option allowed under US GAAP, and that's the indirect method. With the indirect method, we start with net income, and then we add in all of these changes. Whoop, not my net number here. And that gives us cash flow from operations, or from operating activities. You get the same number. If you take this net income, this 263,556, and you add all of those adjustments, you'll get this exact same number, which means I can do it either way. Totally depends on what my preferences are as a company and what I think my investors will prefer, sort of. You see, FASB prefers the direct method, but the SEC prefers the indirect method. The SEC wants us to focus on, let's turn net income back into cash flows. They think investors are better off not seeing exact cash, but seeing how net income is different from cash. So while FASB allows either or and kind of encourages direct, the SEC requires the indirect method. So if you disclose a direct method under an SEC filing, then you have to go back and also include an indirect reconciliation as well. So most publicly traded companies will use the indirect method, and because most of the big companies use the indirect method, a lot of small companies use it as well. So even though the direct method might be more intuitive, we show exactly what the cash flows are, we still end up doing the direct method because of the SEC's preference. All right, let's go ahead and pause right there. We've got our worksheet done. We've got all of our changes calculated. All we have to do is put it all together in a full-blown statement of cash flows, and we'll do that next. See you then.